Today is Tuesday, July 30th, and if we take a look at the three markets, we saw that both the Dow and the NASDAQ came down from the low opening to test yesterday's close, and were immediately rejected from yesterday's close. So you can see that the volume in the Dow was particularly high in comparison to relative volume. The NASDAQ was what we've come to expect. But it also had a very clear and strong rejection after a couple of tests from yesterday's high. The S&P 500 never made it to yesterday's high and really suffered from President Trump's statement this morning about China. So the China trade talks were supposed to start this week, and it really doesn't help if you start by bashing the person that you're trying to negotiate with. So the markets didn't like that, and they made it clear in the S&P 500. So what does that mean? The advancers led decliners, but only by 53% to 42%. So that's not a very big breadth. The stock market's McClellan oscillator finished yesterday, or opened today at just neutral, and it's not going to be any different tomorrow. If you look at last summer, July and August, all we did was churn around and below the zero neutral line. So money was coming out of the market, going back in, but there was no momentum to bring money back into the market. And it could very well be happening now. Today was a big day for Apple, of course, so let's take a look at the charts. The SPX, we've been looking at this trend line that started back in January of last year. And that trend line has been pretty solid resistance. We finished only 2 days above that trend line in the last 18 months. And now we've fallen below the 8 exponential moving average. Remember, the gap is still down there. You know, if the Fed lowers their rates tomorrow, there's a possibility, a strong possibility, the market will react. But this means that the market is now totally running on fumes supplied by the Fed. And if you remember back in 2009, 2010, when the Fed were lowering interest rates, everybody was saying this is an artificial market. It's only being fueled by cheap money. Well, here we go again. But the difference is that back then unemployment was at 9%. Now unemployment is just hovering above 3.2%. There's really, and consumer spending is what saved the GDP last week. So there's really no need for a Fed rate cut unless the Fed is A, afraid of Trump, B, afraid to disappoint the market. Neither of those is what they're there to do. Or C, they just want to see the market go higher, and they're willing to support the market with cheap interest rates. So we're going to see. But this is not a market to be trusted. A market that's depending on low interest rates is using somebody else's money and is not gambling with their own money. So they have less to lose. And you need to be very, very cautious. Now, Apple in the regular trading today ended up in a doji. So we did close the gap yesterday, so I'm going to take the gap out. We finished today with a doji, but if we go and show the extended data for aftermarket, Apple popped up to as high as 218.64 and then pulled back. So we're likely to see some continuation of that when we open in the morning. It's just, I mean, they had great earnings. They obviously had a great conference call, and they don't usually anymore talk about what they're going to do in the next quarter, but they may have tipped something off. They have a new phone coming out in the next quarter, but it's not really going to be the phone everybody needs. That's going to be in 2020. We saw resistance on this Fibonacci back here in May at 78.2. Now we've broken through that. There's every reason to think that we're going to come back and test that 78.2. And if we do come back to 213.60, 213.53 and bounce, then that's going to be a stock to either be buying the stock or selling the puts. I tweeted today at 3 o'clock that I was not going to be playing Apple going into earnings because I just didn't feel good about the overall waiting for the Fed tomorrow, not knowing how Apple was going to do in China. And then, of course, the trade talks with China, frankly, are going nowhere. And sooner or later, all of this is going to catch up to the market. And that's why I'm still at about 50%, less than 50, about 45% cash. Caterpillar was down 1.18% today, but what it did was come down and touch the flat cloud. We've always been saying in these videos that flat clouds attract. So what happened to the Chiku span? The Chiku span came down and caught support in two places. So coincidences like this never go unnoticed. And one is that the Chiku span stopped dead on the 200-day exponential moving average, and that was also the bottom of the cloud. So that type of coincidence will attract price. Look where it bounced off of before. It bounced off of the top of the cloud. Its previous support was right around the 200. Its previous rejection was right at the cloud. So the price taken back 26 days to what the Chiku span is reading the cloud perfectly well. So if Caterpillar can take a bounce for the rest of the week off of the 200-day EMA, the Chiku span, then we're headed up to 134.53. I am still long the stock, but short the 135 calls on 700 shares. So I would love the stock to end at 135. That would be my target, and I'd be able to roll into next week. GDX was not able to break out of this bull flag. What is a bull flag? There's your flagpole, and here's your flag blowing in the wind. The last time this happened, here was your flagpole, and here was the flag blowing in the wind. As soon as it broke that pattern, up it went, and we were playing that with about 1,100 shares, and that was profitable for us. The last time that happened before that, we had this type of a flagpole, this type of a very long flag over close to 2 weeks, and then we popped up. So there was an opportunity to make money on these bull flags twice, and we're going to look to do it again, but we're going to set our alert when it crosses the top channel line. Okay? The next one is WDC, and they report earnings tomorrow. So they've got a little bit of a mini flag happening here, but that's not enough for me to get excited about. I no longer own WDC if they have good earnings tomorrow. And the Fed lowers interest rates, and China trade talks progress. It's going to be a good stock to be owning. I still own Whirlpool, 700 shares, but I'm short this week's 145 calls and 150 calls. Look where we stopped. Do you remember that we gave up on this trend line because it was clearly history and behind us, and we drew a new trend line, and we did that, today's Tuesday, we probably did that on Friday, actually Sunday morning, and we've got one starting here, and this was our second, so it wasn't really a trend line, but now it is. Now we've got 3 hits. That's a confirmed trend line, and even more important, price stopped today right on that trend line. So that is now an important line to watch, and we watch it for resistance at this point, but we also watch to see if it'll become support. So we're going to create an alert to see when we cross the trend line, we're going to get an alert, and tomorrow that would be at 150.76, and we closed today at 150.02. So all eyes on the Fed announcement at 2 o'clock tomorrow, and then Jerome Powell is going to talk at 2:30, and it'll be interesting if they lower rates, if he can worm his way out of saying that he had pressure put on him by the President of the United States, and how can he really justify that we need to lower interest rates in such a strong consumer economy, such a strong employment economy. It just doesn't make any sense to be giving the market free money. This is not the time to do it. They'll have no bullets left when the global economy takes a turn, the tariffs increase, and we have trade tensions, all not good. And that's why I am not excited about the market, and I'm staying 50% cash. My only real long positions now, other than T-Mobile, which I'm in for the 6% dividend, is Caterpillar and Whirlpool, and that's all I want to hold. And if they were all called away from me on Friday, I would be pretty much 80% cash, and that's where I would like to be.